So far this year, though, it's been the same story. It's been all about tech. That has certainly been driving this market's action here. Our next guest, though, raising some concerns about concentration, saying that it actually might pose a risk here to the market in the second half of the year. Kevin Gordon is here to discuss that and lots more. Charles Schwab's Director and Senior Investment Strategist. Kevin, it's great to see you. So talk to me about how you're viewing concentration right now. There is this debate about whether or not this is really a huge risk to the market.
Yeah, so concentration in and of itself, if you're looking at, the largest members in any index, the S&P 500 probably the most in focus, the 10 largest being almost 40% of the index, that often gets, sort of pointed to as the thing that's wrong with the market or the thing that's bad. That in and of itself is not necessarily the bad part. The bad part is if you have, a fewer number of stocks that are leading you to all-time highs, and then you have a breakdown in participation and the actual number of companies and the rest of the index that are doing well. That's something that we've started to see over the past few months. It's become a lot more glaring recently. So you've had this tale of two markets where, at the index level, for indexes like the S&P and like the NASDAQ 100, you're consistently making all-time highs this year, which is great, but at the same time, you're not seeing enough of a pickup at the rest of the market. So if that persists into the second half of the year, that's where we'd see more of the risk, where you have maybe a risk of a catch down from the indexes as opposed to maybe more of a catch up from the rest of the index. It's very similar to what you started to see at this point in 2021. It's not an exact replay because we're in a different part of the economic cycle, but in market terms, what you saw in 21 was consistent new highs for the market at the index level, but a breakdown in breadth. And of course, that led you to the bear market in 2022.
Well, it was interesting as well here. As we're talking about concentration, everybody, when they think concentration, they think about the Mag 7. I saw you tweeting about this morning with regard to a range of other things as well, as much as I'd love to talk about the foreign policy implications of pandas.
Yes.
The Magnificent Seven is back at a new all-time high, cohort up by nearly 56% year over year. What does that tell you about the concentration that investors are still willing to dive into at this juncture when you see the Mag 7 still leading the pack here?
Well, I think, I pay more attention to the sectors that group represents, which is really just communication services, tech, and consumer discretionary. And, the price performance for those members, if you look at the top 10 performers in the S&P 500 this year, there's only one in the Mag 7 group or the Fab 5 group that makes it in that list. So large doesn't necessarily mean top performer. But I think within that group or within those sectors, it seems, that in the post-pandemic world, that for now at least, investors have been more willing to treat those areas of the market as defense. Even if you look at the past few months, softer patch of economic data almost across the board, nothing, Armageddon-like, but something that's a little bit softer, but you've had this sort of relentless run into those parts of the market, even though valuations, whether it's for semiconductors, whether it's for parts of comm services, are still, quite stretched. So it just tells us that there's still a huge willingness on the part of, a good chunk of investors to jump into those areas and sort of treat them as defense and not look at the traditional defensives like utilities or staples or even healthcare.
Kevin, I want to go back to what you just said a moment ago. You're talking about some of that, the fact that the broader market lacks participation from many of the stocks. And you actually tweeted a great chart, I believe it was yesterday or maybe it was this morning, about the Russell 2000's performance relative to the S&P. And you compared what we've seen since October 2022 lows and then going back, coming out of previous bear market territory. I'm curious, in terms of the catalyst there, in terms of what is going to turn that around, is it all about rate cuts? What is it going to take in order to spur some of that activity outside of just those handful
I think
of stocks?
to some extent, yes. And what's fascinating about the chart is that in those prior three instances, so this is really the only, the bear markets that we've had in the past 20 years where you've had more than a 20% drawdown. What's interesting in the three that preceded the current one is that first of all, they were associated with recessions. Second of all, these came after the Fed had already gone through a relatively aggressive cutting cycle. So we haven't really had either of those. We've had some form of a rolling recession through the economy, but we certainly haven't had Fed rate cuts. So I do think that, yes, rate cuts are probably a part of that formula where small caps have to do well. However, there is a, much like we talk about with indexes versus what the average member is doing, that's very much the case in an index even like the Russell 2000. Yes, the index has struggled, but if you look over the past year, the companies that are profitable versus non-profitable, the profitable cohort is up by almost 13%. The non-profitable cohort is down by about 2%. So you do have this split even within an index that has a good chunk of, relatively low quality companies. If you were, sort of screening for quality as a small cap investor, you can still find some pretty consistent outperformance. It's just not going to show up at the index level. I think that's the more important takeaway, even though the index itself has underperformed the S&P 500, by a significant degree since the bull market started.
We're about to begin the next earnings season in a few weeks here. What do you think the overwhelming theme that we hear or that prevails could be here?
I think, a couple, one that we've talked about a lot, I know the three of us, just, sales versus profit. So what's the actual demand picture look like versus how much of that profit growth is being achieved via cost cutting? I think the other part too is sort of the price versus volume. What's the actual growth in unit sales looking like? Because, as we go through and continue the disinflation that we've seen over the past year, which is a good thing generally for the economy, it's not always the best for companies that have benefited a lot from inflation. So you have to keep that in mind too and look what actual unit sale growth and unit sale demand looks like on a company by company basis. But I think the more important takeaway from the part of the market is that you're moving into, sort of solidly into double-digit earnings growth territory for the S&P, which is great, but also not consistent with the strongest gains when you look back in the history of the index. So it's not consistent with, an outright decline. But as you move further into the earnings cycle where earnings growth gets better, the market has already started to price that in, so you sort of dial back the expectations.
Kevin Gordon, Charles Schwab Director and Senior Investment Strategist. Great to have you here on set with us.
Thanks.
Great to see you.